I'm Vishnu. I will be presenting on analyzing historical stock market data and predicting the closing price using transformer based deep architectures. For visualization, we used the clean stock data from Yahoo Finance spanning from 2013 to 2023. Each day's data includes six columns: open, high, low, close, adjusted close, and volumes, capturing days' first and last traded price, intraday's high and lows, and adjusted closing price accounting for dividends and splits, and total shares traded. We begin by visualizing the data to understand the market dynamics. Using line charts and moving averages for Apple stock data, we saw clear long-term upward trends with occasional short-term volatility. Daily returns histogram revealed typical small daily price changes but occasional large swings, which is an indication of market risk. Volatility analysis with rolling window highlighted periods of market turbulence as well. Next, the correlation heat maps and the multi-stock line charts showed positive relationship between major tech stocks while a smaller firm AAME was less correlated. Normalizing the structure allowed us for fair comparison regardless of their absolute uh, value. For modeling AAME's data, we used a transformer encoder leveraging its self-attention mechanism to capture long-range temporal dependencies, which is vital in stock forecasting. We experimented with context windows of 10 and 30 days. Uh, Results and visual evaluation show that the longer window slightly improved prediction accuracy, although performance remained moderate, highlighting the difficulty of stock prediction and market complexity. Finally, applying the same methodology to Apple's stock data specifically resulted in a weaker predictive power compared to AAME, likely due to its high volatility and external market influence, which is not captured with the daily prices and volume. In conclusion, while transformers show promise for financial time series prediction, future work should incorporate richer features, technical indicators, and hybrid architectures to improve robustness and forecasting
To
accuracy.
talk about option pricing methods. We've chosen two analytical methods, which is the Black-Scholes model and the binomial model. And the data that we've taken is from Yahoo Finance through the Yahoo Finance library, and it has options data until 2028 January. It has the fields of contract symbol, strike, bid, ask, implied volatility, price, and remaining. And we've not done much data pre-processing because the data is mostly clean. However, we've done exploratory data analysis, and it can be viewed in the README file. And Black Scholes has key assumptions, which is the stock price movement is Brownian motion, no dividends, frictionless markets, and more importantly, it is only applicable for European options. And the mathematical formula is given as follows, and the derivation is given in the README file. And we've built a custom Black Scholes model function, and we finally returned the call price by calculating it. And we've also plotted the graph accordingly, and we've gotten the R score value to be 0.941, which is closer to 1, which is desired. And secondly, we have the binomial options pricing model, which is suitable for American options and European options. And it basically models the price of the underlying asset as a recombining binomial tree. And the derivation for this is given in the README file, and we finally get the risk neutral probability. And we use this as the discounted expected value under risk neutral probabilities, and we find the Cij as given in this formula. And we also built the custom model for binomial option pricing, and finally we returned the expected call value. The limitations of both of these is that it is computationally expensive and it cannot model large amounts of data.
Historical data from Nasdaq dataset on Kaggle covering the years from 1980 to 2022. I began by exploring and visualizing the data, looking at long-term closing price trends, trading volume, and technical indicators like RSI and MACD. Then I cleaned the data by hand and handled missing values and engineered new features like log returns, moving averages, and rolling volatility, which helped the model detect price trends and momentum. Next, I applied a classic GARC model to forecast daily market volatility, capturing how market risk changes over time. The GARC output was then combined with other features and fed into an LSTM neural network, which uses the past 60 days of data to predict the next day's return. So, after training, the model achieved an RMSE of 0.018, showing that the accuracy can be improved. The hybrid approach works effectively by combining statistical volatility modeling with deep learning.